please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, now for the big moment, UBS kicks off its two-day India Conference 2017 this morning in Mumbai, and joining us ahead of the early action on day one is Gautam Chhaochharia, Head of India Research at UBS Securities. Gautam, good morning. Thank you very much for joining us. Well, first up, what is the mood out there? FIIs have been sellers, and of late, of course, in the last 4-5 days, we have seen a bit of a risk-off. Is it that we are going to see lower levels? Are the FIIs worried about valuations?
Good morning. Firstly, the FII interest seems still very, very high in India because this is the 12th year we're having this conference. But in recent few years, this is the record attendance we are seeing. We are seeing more than 100 overseas investors attending this conference, which we haven't seen for the last few years. So that interest seems to be high. And when we talk about FII selling, and if you look at the numbers also we have seen for very specific months, they are actually very, very small compared to the size of investments they have in India. And if you look at the broad math, they're still overweight India. In fact, India is the most overweight market for most FIIs. So it's just a trimming, and the trimming reflects, as you said, largely valuation concerns in India in the context of earnings momentum being still sluggish. So unlike a year back when India used to be at least the least bad market for many FIIs and with a strong reform story, now we are seeing other emerging markets and Asia markets seeing strong earnings momentum, which while India still sees negative earnings momentum. That's another reason why they have trimmed. But yes, the last few days has also been about global risk-off to some extent.
Gautam, good morning. So talking about earnings, your thoughts on the earnings season gone by. You have been slightly bearish on the market and have lowered Nifty targets. Going by these earnings, do you see a rebound in earnings at any point, maybe in the second half or next fiscal? And would you be looking to change your Nifty target now?
So the Q2 earnings on a headline basis seemed fine. They actually met broadly ours and street estimates. It's only a slight miss here and there, but at a broad level they were fine. But if you go beyond that, the inline numbers were broadly because the margins were better than expected, helped by cost cutting in various companies, GST input benefit in some companies. While at the top line level, the volume level, it's still sluggish, which was a bit of a disappointment given that this quarter was also supposed to be the post-GST restocking quarter. Now, second half of this fiscal year 18 will optically be supported by the low base of last year's demonetization impact. But investors and markets expectations, if I look at the numbers, so the numbers implied to meet street expectations is 20% earnings growth in second half. That implies we are not just talking about optics in terms of their expectations. They are looking at recovery beyond the optical impact of low base. And that's where we disagree. We think the optics will definitely help. We will see positive Y&Y growth, but not absolute terms meet street estimates. And that holds true for next year also. So our top-down forecast for Nifty, for example, fiscal year 18 is 7%, fiscal year 19 is 13%, while street is at 13-14 for this year and 18-20% for fiscal year 19. So we're still seeing earnings cuts. But as we have seen over the last few months and quarters, specifically this year, markets have ignored negative earnings momentum, possibly because of the strong liquidity environment we are in.
Okay. Morning, Gautam. So looking at the numbers gone by in this season, have there been any changes with respect to your stance? I mean, for instance, you've always liked retail-facing private sector banks over corporate-facing private sector banks. And of course, in the season, we got the big news on PSU banks as well. So are you changing the stance there at all? Are you willing to, sort of go overweight on PSUs now?
So we did go overweight tactically PSU banks on the day the bank recap was announced. But it's a tactical move because the sector is attractively valued. But again, you have to be selective about which stocks to buy there. It's not a broad-based basket call. Similarly, for corporate banks, private banks, top-down, the sector stance is still retaining a neutral stance. But our banks analyst is quite positive on few select names there and has also upgraded a couple of names there over last few months. So yes, broadly, financials stance is still overweight. And we're still maintaining that stance.
Where are the NBFCs in your scheme of things? They've started selling off lately, so is it a buy for you at lower levels or no?
So yes, we do think the NBFCs are a buy at lower levels because our NBFC analyst thinks that the impact from, say, recent increase in interest rates will be very, very marginal and not significant. And because of the correction, now the valuations also at least are relatively more reasonable. And structurally, the growth story is intact. We still haven't seen the impact of government's housing push, etc., showing up in mortgage numbers, and markets are expecting that to play out given the way they are looking at the macro construct. So that will also be a positive for again, NBFC is a very dispersed sector, so we continue to like the vehicle finance companies and the mortgage finance companies.
Okay, that's fair enough. Gautam, you have overweight on IT services, but I don't see any IT stock among your most preferred large caps. Bit of a dichotomy here. Thoughts on IT? We've seen quite a bit of rally actually here.
So we do have one name there. I don't know the table you have there, but we do have one of the IT services names in our most preferred list. And IT services, we turned tactically overweight early this year. We had been negative for last 3 years. And that's reason is because our view is that the sector will stop disappointing expectations. So our concerns on the structural risk over last 3 years is now part of street expectations. So disappointment will be behind us. Valuations are very reasonable now. And there remains possibility of some kind of a cyclical pickup in the US IT spending, which could mean positive surprise for these companies.
So, Gautam, talking about consumers, why is it that you like staples more than discretionary? Sure, staples came out with pretty decent numbers. I guess most companies had good volume growth, but prices are also very, very high. So what's the rationale behind the bias?
So it's not a very strong sector level call, I would say. It reflects more the stock level comfort. Even discretionary, we like specific names in terms of our conviction. But the broader level difference at a strategy level reflects two things. One, our slightly defensive market view. So in that sense, staples is a better place for investors to be in rather than discretionary. And secondly, our view of the growth recovery, second half this year and even next year, is a lot more muted than what the markets are pricing in, which should also be helpful for staples rather than discretionary. And again, you have to remember that staples have been coming off last couple of years of weak volume, etc. And we are seeing signs of volumes picking up for that category. Also, given the context of government's tilt towards supporting rural and lower income population, which is a lot more positive for staples than discretionary.
Okay. I'm not able to understand this underweight on cement. You're not betting on the big affordable housing use of cement?
So our view on affordable housing is, if you look at the big picture numbers, a lot of the numbers are over ambitious in terms of funding and execution constraints which government in India has. A part of that affordable housing program is very, very powerful from the macro perspective, which is the middle income urban housing plan. And if you look at this perspective, then the numbers implied for cement in terms of incremental demand is not material, and it will still not swing or lead to a big permanent stocks, and which is what the stocks are pricing in right now. So there's a big disconnect about what the stocks are pricing in and what, in our view, will play out. In general, the sector should still be okay in terms of delivering some level of growth, but not where the stocks are expecting or pricing in.
Okay. In general, Gautam, what's the stance? I mean, even though, as you said, earnings have disappointed several times, the liquidity tap is on. So do you think this market is more likely to cross, say 10,500? Even that doesn't look like a tall ask, say 10,600, before it challenges, say, 9,900?
Very well it could, because the liquidity, as of now, the drivers of liquidity still remain separate. I'm talking about local liquidity. Global liquidity is far more tougher to predict, and I don't see global liquidity tightening in a hurry, because our global view is that the Fed's tightening cycle should be broadly smooth and gradual. Local liquidity wise, the biggest driver of liquidity in our view for local mutual funds is in simple terms 1 year rolling returns. And last 1 year rolling returns are in the positive territory, in a good positive territory. So that condition itself justifies that local liquidity could be okay. The risk to that thesis would play out if we see meaningful rise in deposit rates by banks, again, we haven't seen any signs of that.
So Gautam, then last word, we've had a lot of, every time the market falls, obviously we're all looking for reasons. Now it's been the rise in bond yields here, concerns around fiscal, with the GST cuts coming in, crude prices moving higher. Are these transitory factors according to you, or are these real headwinds which perhaps could put a sort of a meaningful wall in front of the bulls on the street?
So our view on all these global factors as well as the local factors you mentioned, to us at this stage seems transitory, but you never know if oil has other drivers which we are missing right at this stage. But we have to remember that from a government perspective, the big oil bounty which India saw is now behind us. And whether oil rises up sharply or even remains at here, it will be a challenge for the government to keep supporting the economy as well as meet its fiscal requirements.
All right. We'll leave it at that, Gautam, and touch base with you after the conference to check out how your views have changed. Thank you very much for joining us with your thoughts today.